Welcome to the Wealth Studying Podcast. This is episode 481. Today is July 18th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Hey, today I want to do just a real quick episode because I've gotten a lot of questions about, hey, is this a market top? Are we about to see a correction? Well, here's the deal. Is the market topping out? There's a lot of indications that look like it is. But just because we're at a record high doesn't mean it can't go on to do more record highs because, right, mathematically, the only way the market can go up is if it continues to break record highs. What does concern me and has worried me for, a month or more now, and that's why I sold my concentrated position in utilities and took profits a while back so that I could have cash on hand in case we got to some type of a summer sell-off. Now, we are in the dog days of summer. We haven't seen a sell-off yet. We might not, right? It's just a matter of assessing probabilities. Overall, I continue to be cynically optimistic about the general direction of the stock market from the areas that I'm focused in, which are that, industrial digitization or the industrial tech side of things. I continue to emphasize the things that we've been talking about on the Wealth Studying Podcast now for over a year about the impact of bringing supply chains either back to North America or into the U.S., or at least somewhat nearshoring, if nothing else, at least trying to cut some of the reliance on China. And more than anything, this has to do with national security reasons, but that's also combining with other trends that, I wrote about in my book in 2016, The Robots Are Coming, about the ability for artificial intelligence and what I called back then decision support systems, as well as advances in computing and in robotics and automation, and how that would eventually make labor cheaper in the United States, or at least competitive with cheap labor in other countries. And when you add in the national security aspect of this, and the fact that during the pandemic, so many people realized that their just-in-time delivery systems were not adequate, and with all the geopolitical instability, especially since Russia invaded Ukraine in 2022, well, you combine all that together, and especially with the advances in artificial intelligence and large language models that we've seen over the last couple years, and more that reinforces the trend of industrial technology. Yeah, we not only need all the computing systems, but we need all the power to energize those systems. And if you're going to energize those systems with power and move around all those electrons, well, it takes a lot of natural gas and diesel fuel and railroads and a building out of manufacturing facilities like we haven't seen since World War II. In any case, let me get back on topic. Bottom line, are we at a market top? Well, probably. Again, I'm sitting on a pile of cash. If there is a dip, I'm going to buy into it. A couple indications why I think that the market has gotten a bit frothy here is you're seeing a lot of FOMO, right? A lot of fear of missing out. People panicked about the tariffs. They sold their positions or they didn't buy in the April dip. They've seen the market go on to all-time record highs, and now they're trying to get back in. You're especially seeing the FOMO, and this is what's most concerning to me. It's in those meme stocks, where you're seeing a lot of really low-quality stocks not only rising, but actually outperforming the general market. So a real indication of FOMO is when you see, what's called the dash for trash, or the old euphemism about when the pot boils, the scum will rise. So there's a lot of activity in those really sketchy and, in my opinion, a lot of them real scammy type meme stocks. And I'll bring one of them up right now, which actually I don't think is a scam. I think it's really the way of the future, but the future, unlike someone like Kathy Wood talks about, where it's always going to be in the next 5 years, almost like the CCP's 5-year plan. Listen, the future takes a lot longer to get here than we think it does. And while I think things like telemedicine are going to be great future growth opportunities, and they've obviously have done very well overall in the post-pandemic environment. That's going to be one of the methods, along with expert decision-making support systems in the medical industry, along with wearable medical products that will take the cost out of healthcare going into the future. Again, why I think long-term, a lot of the problems and excessive expenses that are associated with things like Medicare and Medicaid Well, a lot of that waste and overbilling and expenses can be taken out of the system, but it's going to be in the future as we apply technology to the healthcare field. And again, one of those critical elements will be telemedicine. But look at a company like Teladoc, right? Its time has not come. During the big meme stock hysteria of the pandemic, Teladoc, I think, got up to something around $300 a share. Today it's trading around $8. Yeah, you heard me right. It went from 300 to 8, and it had been even lower. I think just in the last 12 months or so, it was trading around $6. But in recent weeks, with all this FOMO going on, you have seen it break out. It got up to, well, I think right around $9 before it fell apart, and it's pulled back some. But the bottom line, and what I want to point out with this stock, it isn't that the concept is bad. It's just that right now, unless something drastically changes, they are extremely unprofitable. I think last year they burned through like $1 billion. That's a billion with a B, right? That's a lot of money. And it doesn't look like they're readily on a long-term path to a sustained and growing profitability. Now, I do think they'll get there. I just don't think that July of 2025 is the time to be betting on those future earnings. Right? This is where I think the FOMO is kicking in, where people are just looking at popular stocks that they'd heard about, stocks that had at one time traded at $300, and they think they can buy into it and get rich quick. Well, maybe, but good luck on that. What I think you also want to be careful for is you see this big rise in small cap stocks. Now, hey, I'm generally very much a fan of small cap stocks, but profitable small cap stocks. That's something that you can find in the S&P 600, right? Not the Russell 2000, which is the universe of small cap stocks, but in the S&P 600, which filters for profitability. So you're getting a higher quality of small cap stocks. If you just look at the overall universe of small cap stocks, something in the neighborhood of 40% of them are not profitable. Most of those have never been profitable. They're probably never going to be profitable. They survived over these last decade or more because of all the quantitative easing, extremely low interest rates where they could continue to borrow enough money to stay operational. But I think the era of super low interest rates is over. And at some point, these companies are not going to be able to extend and pretend anymore. And so these zombie companies will in fact either go out of business or they'll get ready to set themselves up for the next big, what I would consider a financial scam. And that's this whole emphasis on private equity. More and more you're seeing advertisements about, you, the individual investor, the little guy, you're going to get a chance to be rich like the billionaires and own private equity. Well, yeah, you know what I think a lot of that private equity is going to be? It's going to be like the subprime mortgage loan fiasco in the 2000s, the early 2000s, when they take these unprofitable zombie small cap companies and they bundle them up and they sell them to gullible retail investors that just don't know any better. Again, I digress. Hey, here's the bottom line. I sold my concentrated position in utility stocks, I don't remember, was it 4 weeks ago, 6 weeks ago? I did that to lock in the profits that I'd made in that trade, to limit the high exposure I had to utility stocks. Now, I still own utility stocks, just not anywhere near the concentration I was in before. And I did that because it looked like they kept getting up to a point where they were going to break out and then it would fail. And then they try and break out of another record high and then they'd fail. Well, that actually even looks like it's happening today. The utilities index, if you pull up a chart of it, as of this morning, it was breaking through a record high, but now it's pulled back. We'll see if it goes on to continue in the uptrend. But when I looked at my overexposure to those type stocks and specifically looked at their relative performance, it had been very weak in recent times to the overall S&P 500. Again, pull up a chart of the utilities index and compare its performance with the S&P's performance since we went through the tariff tantrum. And you'll see that the S&P 500 is up something like 20%, and yet the utilities index is up less than 8. So drastic underperformance. I still want to own select utility companies because we are going to continue to see this demand for electrification. and I want to keep my hand in that market, but I wanted to lock in those profits so I have that dry powder available in case we get a dip over the summer or possibly into October. You know, that time, August through October, historically, is when we've had the biggest drawdowns in the markets. And I really don't expect a huge drawdown in the market unless we get a big geopolitical black swan that comes about. What I'm looking for is a garden variety, 5%, probably less than a 10% pullback. If we get that, hopefully I'll be smart enough to go in and buy that dip. And I'm going to continue to invest in those stocks that I think are long-term favored for United States and North American industrial technology growth. Oh, one other thing. When I talk about being in cash, and right now I'm probably in the range of 20%, that isn't just like buried in my backyard or under a mattress somewhere. I've got that money sitting in a money market fund. In my case, I use Charles Schwab as a discount broker. Their prime money market fund, SNAXX, that's paying a very competitive rate. Right now it's at about 4.27. And when you look at the 10-year Treasury, which is at 4.42%, you're effectively being paid a 10-year Treasury rate, but your money is only tied up on a daily basis. It's almost a no-brainer not to put all your spare cash into a fund like that. I will preface this by saying that that particular fund, you have to have $1 million to get into it, but they have other funds that, just require $1. They don't get as high of an interest rate, but it's still very competitive. The advantage to a fund like SNAXX is that Schwab's policy is that you need $1 million to get into it, but you don't have to maintain $1 million balance. So for example, if you have $1 million cash, you could buy into that SNAXX and turn around the next day and take everything out of it other than $1, just keeping $1 balance into it. And then it allows you to, at any other time, put more money back into it, and you continue to get that $1 million interest rate, even if you only have, $1,000 in the account. So that's what I do when I swing trade. I move my money in between a very high yielding, very high quality, very safe money market fund, keep my cash there as dry powder, and then buy back into the market when I see either a broad market secular opportunity or just individual stock opportunities. And I'll tell you, even though I've been having this 20% or so cash position for the last, whatever it's been, 4-6 weeks, my overall portfolio is not suffering. And that's not even just on a risk-adjusted basis when you figure that I have so much money in cash, but even when I compare my daily performance and balances against the performance of the S&P 500, I'd say a good bit of the time I'm either right along with it or even outperforming. Now, I only use that as an example for those people that say by being in cash, you're losing out on daily performance, right? It all depends on what's going on in the market at the particular time. It's not always that way. I sat through a good bit of 2023 when I was worried about a prolonged market downturn and a possible recession. And I did have the quality and the safety of being in, a high-yielding money market fund. But at the same time, the market went up and I missed out on those opportunity costs. So being in cash doesn't always pay off. But in my opinion, there are times when you want to move a portion of your portfolio into cash to keep a little bit on the sidelines so you can buy back in at potentially lower prices, or at least when there's less risk in the market. Hey, in any case, just my opinion. Until next time, as always, this is John Pugliano wishing you the very best returns.